Hello everyone, welcome to BUS 327. This week we're going to be talking about the cost of capital. So a firm that has excess cash, they can do two things. They can either pay a dividend, a cash dividend, or they can invest it in a project. So a firm with excess cash, they can either pay a dividend or make a capital investment. If they pay a dividend, the shareholders can then invest in financial assets, and this would ultimately increase the shareholders' end value, or they can use the money to invest in a project, which would also increase the shareholders' terminal value. So this is because the shareholder can reinvest the dividend in some other type of risky financial asset. The expected return on a capital budgeting project, so if they decided to invest in the project instead, the capital return on that project should be at least as great as the expected return on a financial asset of comparable risk. So, from the firm's perspective, the expected return is the cost of equity capital. And so to estimate the cost of equity capital, we have to know the risk-free rate, which is R sub F. We have to know the market risk premium, which is represented by R sub M minus R sub F. And this gives you the market risk premium. What that means is the amount that the market demands over the risk-free rate. So if the risk-free rate is 7%, but the market looks at this and says, well, there's a certain amount of risk involved, so we want an additional 3%. And then we also have to know the company beta, okay, which will be given to you for the most part in your homework problems. So let's look at an example. So suppose the stock of Stansfield Enterprises, a publisher of PowerPoint presentations, has a beta of 1.5 and the firm is 100% equity financed. Assume a risk-free rate of 3% and a market risk premium of 7%. So 3% is your risk-free rate. But the market is saying because this particular firm has some risk involved, we want an additional 7%. So what would be the appropriate discount rate for an expansion of this firm? What would they expect as their discount rate? So here's your formula. The rate of the stock, R sub 0, is equal to the risk-free rate plus the beta times the market premium, which is represented by the market rate minus the risk-free rate. So the price of the stock is equal to 3%. They told us that was the risk-free rate, plus 1.5, which is the beta. They gave us that as well, multiplied by 7%, which is your market risk premium. So this works out to be a rate for the stock of 13.5%, a discount rate for the stock of 13.5%. Okay, so suppose that Stansfield Enterprise is evaluating the following independent projects. They each cost $100 and they each last for 1 year. So we have project A, B, and C. They all have a beta of 1.5. They give you the estimated cash flows, and they've calculated the IRR and the NPV at 13.5%. So let's look at a securities market line that we have plotted these three projects on. And we've listed the IRRs on the vertical axis and then the firm's risk on the beta axis, or the horizontal axis. So an all-equity firm is going to accept projects whose IRR exceeds the cost of equity capital and reject any projects when the IRR falls short of the cost of capital. So you can see that here, and I think they meant to have 1.5 there, not 2.5, because it said the firm's risk was 1.5. The beta was 1.5, so I think that should be a 1.5 there. But you can see that they plotted the securities market line here, starting with the first one that had an IRR of 5%. Okay, if we go back and look, that is going to be Project C. And so if we look at the market line, we can see that it falls below the market line. And so we would reject Project C. If we look back at it, it provides us with $105 in cash flows, but also notice that it has a negative NPV. So right off the bat, looking at that, I know that I'm probably going to reject this one because it has a negative NPV. But looking at the SML graph, it just confirms that for me, that I would reject number C. Now let's look at number B. It has positive cash flows. The IRR is 13.5%, which is the same as the discount rate, and then the NPV is 0, so it's not negative, but it's 0. So you can see the SML, that project, it just fell right on the line. So you probably want to continue to look at that and evaluate it, look at the payback period, look at all different things, and then decide which one you're going to go with. It looks like Project A is probably going to be the best project. It has an IRR of 25%, which is the internal rate of return is much higher than the discount rate, so I would think that would be good. It also has a positive NPV. So these are just tools that you can use to help decide on which capital projects to take. So Treasury securities are close proxies for the risk-free rate, so that's typically pretty low. In this example, it was 3%, but you would be able to look it up by looking at the Treasury securities rate. The CAPM model is a period model. However, projects are long-lived, so the average period or short-term rates would need to be used. The historic premium of long 20-year rates over short-term rates for government securities is 2%. So the risk-free rate to be used in the CAPM could be estimated as 2% below the prevailing rate on a 20-year Treasury security. So method 1, you would use historic data, and method 2, you can use the dividend discount model. Market data and analyst forecasts can be used to implement the DDM approach on a market-wide basis. So the return on the stock is equal to D sub 1 divided by the price plus the growth rate, and this will give you your market risk premium. I hope you all found this helpful, and I will see you in the discussion.